Commercial Real Estate Show videos are brought to you by Bull Realty, Commercial Brokerage Services. When your business requires proven performance, visit bullrealty.com.
Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. We have some incredible shows coming up in the next few months, like a show on social media for business and a show on commercial real estate training. You do not want to miss these. If you'd like to receive an email once a week announcing the show topics, you can sign up at the show website, commercialrealestateshow.com. Well, today we're looking at ways to save tax dollars and increase cash flows. My next guest is Hampton Mallis. Hampton is a CPA and principal of Reznick Group. Reznick Group is a top 20 national accounting, tax, and business advisory firm. Reznick Group is well known for their depth of knowledge in real estate and tax credit services. Hampton Mallis, welcome to the Commercial Real Estate Show.
Hey, Michael. Thanks for having me.
Well, we appreciate you being here in Hampton. I want to talk about COD, and it's not cash on delivery. Unfortunately, it's cancellation of debt, which you might like getting the debt canceled, but the taxes sometimes can be a surprise. If owners of real estate have cancellation of debt through foreclosure, short sale, or other ways, they're being relieved of mortgage debt. That resulting cancellation of debt is a taxable event, right? And can you explain how this works?
Sure, absolutely. Well, first of all, COD income, cancellation of debt income, and forgiveness of debt income, there's a lot of words for it. So I might use them interchangeably here, but let's talk about a short sale. A short sale is when a lender agrees to take a discounted payoff on a loan. So when the property's sold, the owner pays off the loan at that discounted amount. Well, the difference between that payoff and the face amount of the note, or the outstanding portion, is COD income. And for tax purposes, that is taxable. We also see this too in the past few years about with owners working out debt with their lender. So the lender, instead of having a sale, has agreed to modify the debt for maybe a lower principal amount. Well, the difference between that lower principal amount and the original outstanding debt is going to be COD income as well, and taxable. Well, you also mentioned foreclosures. Foreclosures is a total different animal altogether, because there's different types of debt. There's non-recourse debt, which is of course is just secured by the building, and then there's recourse debt where the owner has given some kind of personal guarantee back on that debt as well. So it's secured by the property and that personal guarantee. When you have recourse debt, we'll take that first. Is the foreclosure, the owner is treated as selling that for the fair market value of the property. So, and typically that fair market value of the property is going to be less than the outstanding debt. So the difference between that is going to be your COD income. The lender has the right to go after the owner if they want to for that cash, or they can forgive
regardless of the basis, right?
Regardless of the basis. Well, when you sell it, the sales price is going to be the fair market value, and then you're going to have your cost basis. So you could have a gain or loss there too, and then you could have the COD income as well. With a non-recourse debt is treated differently. Since it's only secured by the building, it is treated as a sale for the face amount of the debt. So based on that, and you have no COD income, so based on that, you could have gain or loss on there, and that's some tax planning strategies that you can look at it as well.
Okay. All right. What are some ways that borrowers might avoid or defer taxes from COD?
Well, first of all, I would definitely recommend a borrower start discussing this issue up front with their tax advisors. You don't want to wait until you've completed a transaction and then go to your tax advisor.
A little too late.
A little too late, absolutely. And some ways we've dealt with it over the years is back in 2009 and 2010. Unfortunately, we've passed 2010. The IRS allowed you at the partnership level to make an election to defer that income for 4 or 5 years, and then you could recognize it over a 5-year period. Unfortunately, we've passed that time frame now, and now what we're looking at is planning at the partner level, because most real estate is held in a partnership form, and when you have that forgiveness of debt, it passes out to the individual partners. Over the past few years, we've looked at the insolvency of the partner. If the partner is insolvent, they can make an election where they reduce other basis of other property they have or other tax credits they might have, and then sometimes some of it just goes away, which would be great to somebody that's insolvent. Also, under the code, there is the Qualified Real Property Business Indebtedness Election.
Yeah, this is interesting.
And so what does that mean? It's basically an election to reduce the basis of your property that you held, or that you're modifying the debt on. You have the COD income on. So the goal is, and you've got to go through a number of steps. You got to look at the fair market value of the property, what your tax basis is in the property, and if you meet those certain deadlines, then you can reduce your basis of the property, and then you're deferring the income. So in most of these tax strategies, you're really deferring the income to a later date. There are other tax strategies that you can use, but you really got to focus on the individual investor or borrower and determine what their tax situation is.
In the case of two partners, if one partner has nothing, so he gets out of the deal, is the other partner responsible for the entire COD or their portion?
If they get out of the deal before there's a COD event, then there is only one partner that's going to affect. Now, as I mentioned before, is that a lot of these deferrals are at the partner level. So while one partner might have the opportunity to utilize some of the deferral, the other one may not, and you see that a lot when one partner's insolvent and the other one's solvent.
Right. That's interesting. Well, we have to take a quick break. If you appreciate the show, do reach out to our sponsors. I'm Michael Bull, and this is the Commercial Real Estate Show. We'll be right back.
Commercial Real Estate Show videos are brought to you by Bull Realty, Commercial Brokerage Services. When your business requires proven performance, visit bullrealty.com.
Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Well, today we're looking at ways to save tax dollars and increase cash flows. My guest is Hampton Mallis. Hampton is a CPA and principal with the Reznick Group. Hampton, I want to ask you about buying notes and selling notes. Some investors are buying notes to get to the real estate ownership. How might COD taxes and other taxes affect a note purchase?
Well, we've seen this over the past few years as well, and typically there's three investment strategies. There's the buy, hold, and service the note. We see this a lot when they're buying portfolios of notes. There's buy the distressed debt, the note, and modify it, and then also buy the debt to get to the real estate, as you mentioned, and do a foreclosure sale. In each one causes different types of phantom income. There's really no COD income. There's phantom income. For the hold and service the note, you have to worry about market discount issues. So basically, a portion of the principal could be ordinary income. If you modify the note, then what happens? You're buying it at a discount. So, an example, if you have a note for $1 million, you buy it at $600,000. And then you remodify the note with that borrower for $750,000. Well, you have a significant modification, and you have $150,000, the difference between the new face of the note and your cost of phantom income.
Okay.
We also see this a lot on the foreclosure sale when you're trying to get to the property. So in the same example, you buy the note for $600,000. You foreclose on the property. It goes out to bid. You bid it up. You can bid up to $1 million because that's the amount of the note. You could go higher, but typically we don't see that. So say that the bidding goes and you bid $750,000. Well, the IRS is going to look at that bid price as the fair market value of the property, unless you can prove otherwise. So now you've paid a note for $600,000. You've bid on it for $750,000. So then you have this phantom income of $150,000. So the goal is to speak with your tax advisor in advance so you understand these issues. And if you run into these situations, then you can plan to do some stuff about it.
So are you seeing some people surprised by this income?
I see people all the time surprised about this income, and typically the reason is because they didn't speak to their tax advisor ahead of time. So I definitely recommend that.
Well, hopefully they heard this show or watched this video, right? And they'll know. Well, what are some year-end tax saving ideas for listeners to the Commercial Real Estate Show?
Well, there's a number of things that people can do, and to kind of throw out to some of your other segments you had today is cost segregation studies is a great thing to do at year end, so you can increase your losses flowing out to you. Investing in your retirement plans, maximizing that out before year end. Conservation easements is really big out there. So with a conservation easement, you're getting a non-cash charitable deduction. Charitable deductions by year end, make as many as you can, donate to Goodwill, keep records of all that as well. You can also prepay your state income taxes before year end to get the state income tax deduction. In states where there's not a state income tax, then you can also look at sales tax, which got extended again. So you can look at those as well.
Okay. And quickly, we're close to the end of the show, but give us a definition between passive and non-passive as far as that goes for real estate professionals.
Sure. Passive, such as from rental real estate. If you're not a real estate professional, then income and losses flowing out from a rental real estate property is going to be considered passive. And a typical person can only offset that against other passive income. Non-passive income is losses that can offset any type of income you have, and that's the benefit of qualifying as a real estate professional. Is that you can use those against other income. Okay,
well, interesting. Well, Hampton Mallis, thanks for joining us today and sharing your insight.
Thank you.
If you'd like more information from Reznick Group or any of our guests today, their contact information and website is available at commercialrealestateshow.com. I have a question for you as a listener. Can you join us next week? Well, I hope so. I promise another informative show. Thanks for spending some time with us. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.